Hi everyone. Whenever we talk about the investment, we directly think that we are going to be exposed with the risk. Why it is so? And what is the risk? First of all, we have to understand what is investment. In a simple term, if I like to explain what is investment, then I will define it in one line that the commitment of fund is a investment. Simple. Nothing else. The commitment of funds. Now, you have to think that then what is the difference between business and investment? Because we are going to commit our fund to the business purpose also and for investment also. Then there must be some difference. Then yes, difference is there because whenever we commit our fund for the investment, we get only agreement or a receipt in the paper. Okay. Whereas whenever we commit our fund to the business, we get some physical things like if we are going to invest our fund in business, then we'll purchase something and in return of that we get that item in physically. Suppose a real estate company is going to purchase a piece of land, then he will commit his money and he will receive that part of the land. Okay. Similarly, if some business is going to purchase some goods, like whatever may be, like cotton, rice, wheat, whatever may be, then the business have the physical goods in return of the money or instead of money. Whereas in investment, we commit our fund and receive one piece of paper like receipt or an agreement or a certificate, nothing else. In that case, the investment is at risk because if our investment going wrong, then we don't have anything. That agreement is broken, that piece of paper is of no value because investment has gone wrong. And in that situation, what we can imagine? We can imagine that suppose we have investment in a bond and that has defaulted. Okay. Similarly, if we have purchased a share of a company and company is gone default. Okay. In all the cases, we will have nothing. You can define it as investment is a risky job. Okay. Investment is a risky work. Whenever we'll talk about the investment, it means we are talking about the risk also because investment is associated with risk. Now we have to understand what is risk, why it is so important. Then whenever we'll talk about the investment, we have to think about the risk. And if we are thinking about the risk, it means we have to calculate the risk. And this will define that for a particular investment, how much risk we are going to exposed with. We have to understand what is the risk. And for that, I am taking you to the screen. Now, friends, suppose you have one investment or you have investment in a company or in a bond, whatever may be. So what you are expecting? Expectation is that any investment is made to grow. Means any company or a bond or whatever it may be that is made to grow. If it is not growing, then no one going to invest in that product. Okay. So by default, it is made to grow. Suppose you have invested in a company and expecting a sort of return. Now, how you will plot that? Now, on the x-axis, you will put time. Okay, this is time. Let it be 1 hour, 10 minutes, 1 month, 1 year, whatever may be. You just it is a sample. So, and this is your return. On y-axis, you are putting return. Then during time, if your investment is giving 10% return, then definitely you will expect that this return will continue to 10% and the line will be this. Okay, this will be the line of return. But you have to think that if this return goes like this, then it is a very simple line of return. Okay, but always it will go like this, and again it will come to down, and again it will go to this, and this will be going like this, and this return will be made in future. You have to think that in a particular time it moved from this return to here also and this return to here also. Means your investment has generated a positive result also and a negative result also. Means this return is deviated from the mean value. Okay, this is the actual deviation of the mean value. Means I have told that 10% of the expected return. So it will not be always 10%. Sometimes it may be 20% and sometimes it may be 0 also, or maybe 5%, maybe 15%, like this. At some point it has gone there, means negative return, and sometimes it has gone here or here, means positive return. In a summary, what you will think? That at a particular time, what we'll get will be this line only. We'll have this line as a return line. Okay, so we have to calculate this mean, and after this mean, we have to think that how much dispersion we'll get, means how much deviation we'll get. Okay, then we have to calculate the deviation only. Means if you are going to calculate the standard deviation, which is the angle of the mean value of the return. Okay, so now we come to calculate the standard deviation, and that standard deviation will be called the risk. Now, how we will calculate the standard deviation? Come. To calculate the standard deviation, we have to think about the data, means the return in a particular time. Suppose you are taking a daily return data of a particular security. So simply taking a simple data and we'll calculate on that. So suppose first day your investment gave 10% and the second day it came to 8%, and on the third day it went to 15%, and on the 15th day it come to minus 8%. Okay, and on the next day it came to minus 10%. Okay, again it gave a return of 12%. Again it gave a return of minus 11%. Next day it gave a return of 15%. Now we have 1, 2, 3, 4, 5, 6, 7, 8. 8 data total. So what we'll do? If we'll take a mean of all these data, then what we'll have? We'll have a negative and positive data. So if it may come as it is, I have not calculated till now. So it may be anything, maybe 0, maybe minus, maybe plus, anything it may be. Now let us calculate. Okay, so simple formula we are putting the formula of sum. Okay, and this is 31. Now the this come to 31. Total mean value is 31, but this is not mean. Mean is like this. 8 total data is 8, and if I am going just this is a very simple way I am putting it, and so that you can understand the thing. Okay, now the mean is 3.875. How it has come? If you are calculating here, then simply this 31 is divided by 8. Okay, Now exactly this value has come. Okay. Now what we'll do that we'll take a difference of this mean value from this. Okay. So here we'll put the mean value 3.875. Okay. Now just we fill all the these cells. Here we'll take the difference value. Okay. For that we are putting a formula, and this is minus this mean value. Okay. This has come to this, and this data will take here. Now see, this is again plus and minus value. Then again we'll add on all these things. Then what we'll get, that maybe 0, maybe plus, maybe minus. And this is again we have to take mean of all the data, but this is called the dispersion. Means dispersion from the mean value. The data you have collected, but the return you got, that is deviated from this mean value is this much. So we have to convert it into positive value. So what we'll do, we'll simply do the square up all this data. Okay. And this will be the result. Okay. So we'll have all the square up data. Now we'll make a average of this. So put an average formula, and the average what we'll get is mean value of all the data. Average, right? Average. Okay. And average of this is the average. Okay. Take a square root, means 0.5, then it will come 10.740 is the actual standard deviation of the data. Okay. Means standard deviation. Now we have to think the formula of standard deviation. Okay. This is the formula of standard deviation. What I have told you, standard deviation is equal to a square root of all the dispersion and a square of that divided by the sample number. This is the simple. I have shown you in this manner what is the process to calculate the standard deviation. But if you are going to find the standard deviation on the raw data, is simple way to calculate like this. Right? Standard deviation, STDV, standard deviation, and select this data, the raw data which you had earlier. Okay. And this will produce the result of simple standard deviation. Now, this standard deviation, why it has come to this much? Because this is divided by n minus 1. Okay. That is why this difference and this difference is came here. Similarly, if I am going to make both the standard deviation equal, then see, first we have to take the mean of this. Means first we have to take sum of all the data. I have added all this number, means the number up to the cell number 8. Okay. And the total sum is here 922.875. This is summation of E1 to E8. Okay. Now I have to divide it not by 8, because this standard deviation is taken on the basis of sample data. You have to understand that sample data and population data. Means sample data is simply, you think like this. Sample data is here 1, 2, 3, 4, 5, 6, 7, 8, 9. Now sample data is this. This is the sample data. Like this 1, 2, 3, 4, 5, 6, 7, 8. Whereas all these lines are 9. Whenever we take a sample data, then total number will be reduced by 1. That is why this difference came here. And now both standard deviation same formula, both standard deviation are the same. This is the very simple way to calculate the standard deviation. I think that you might have understood each and every part of the standard deviation. Means this is the collection of data and taking mean, and this is the dispersion from the mean, and this is a square of the dispersion, and then taking mean of the square of the dispersion. What is called? It is called the total process. First you have to collect data, then take the mean, then take the dispersion, and then you have to take a variance. Variance means after squaring up the dispersion, you have to take again mean of the total data. Then whatever will come, that will be a squared root. And this is called the standard deviation. And that standard deviation is this, means by that number, this return can deviate up or down. This is the actual fact. Means this way you calculate the risk of your investment, and on the basis of that you can expect that your investment can give the return with this risk. This is the simple way. Means risk says that your investment can give you this much risk in your return. In this concept, it is assumed that it will not go to zero, but the return may deviate with this number. Okay, this may go like 10%. If you are taking 10% expected return and standard deviation is 11%, then this 10% can deviate from 10% return to sometimes it may go to 21% positive, and it may go to -1% also. This is the fact. Now I think that you might have understood about the standard deviation and how this standard deviation is calculated. You have learned all the process. If you like my way of teaching, then you can contact me. Details are given in the description. You can contact me for your CFA level 1, CFA level 2, and CFA level 3 also. I teach about the portfolio management. I teach about the investment planning. If you want to make a career through NISM certification, you can join my classes for research analyst, investment advisor, and portfolio management services also. So thank you very much.